Hey guys, Freaky Finance here. A couple weeks ago we did City Trends, a retailer that was trading pretty cheap with some catalysts, the underlying land value. Today we're going to look at another retailer on the Canadian side who just came out of bankruptcy. I should disclose that I own this one, and it's also a little bit out of my element because it's the bankruptcy elements make it harder for me to judge what's actually going on. So there's a caveat with this one, and that's probably a reason why it trades as cheap as it does. It also could mean that I'm missing something. So if anyone in crowdsource with Reitmans to see exactly what you think the actual EBITDA that this company can generate is, when there's not only COVID noise, but then you have government subsidy noise with SIRS and SUS, and then you have lease negotiations. There's all types of noise year over year that make judging what this company is actually capable of delivering hard. All right. So Reitmans, we'll talk about a little bit what happened in the bankruptcy court. One of the reasons why I'm excited about it, but Reitmans basically has 3 banners now. They used to have 5, and now they just have Reitmans, Pennington's, and RW & Co. On some history, it's actually a fairly well-known retailer in Canada. Like usually you'll see them in an enclosed mall, something like that, right? Or even on a strip mall in the outlet. It's basically your average, what you imagine an average retailer would be what I would call Reitmans, at least to me. But again, I'm not the target market. I've never actually shopped there. The average store just looks like this on the outside. Reitmans, right? And it's actually I looked at some of the clothes. It looked pretty cheap, so it's not like luxury or anything. It really sounds like a normal retailer. Not super cheap like a discount dollar store. Not super luxury like Capri, right? I guess I'm gonna go a little bit long this time. COVID's coming around, and I don't want to spend as much time editing after the video, so it might be a little bit longer. Because normally I edit the pauses. And try to talk as fast as I can because I like to listen to these back to myself, right, as fast as I can. So, anyway, the reason why, again, kind of like the Capri video, or sorry, the City Trends video, is that I'm trying to find companies that are super cheap on the small cap side. The reason being is we're finally back. This is actually even worse now because this week wasn't very good until Friday anyway for stocks. Today is May 14th, 2022. So I'm trying to find some opportunities on the low end that no one's looking at. There's a couple of things that I'm excited about, so I'm trying to find some. I'm putting cash to work, right? Not so much on the big side yet, unless there's some really good names, because those ones haven't come down as much, right? So on the large cap, you're still at 16.5 times earnings, right? But the mid cap's already down to almost COVID panic levels and almost down to great financial crisis levels. And all we're doing is experiencing a slowdown in rate of change terms, right? It's the stimulus hang up with higher inflation. That's all that's happening. It's not like a credit crunch yet, or a big bubble in housing yet. There's no bodies coming to the surface yet, but the stocks are acting like there is, right? At least on the lower end, not yet on the higher end. So you can see actually the small caps are down to 11.5 times earnings, which historically speaking has been a good time to buy securities, but as a place to add into, right? So that's one of the reasons why I'm looking at random companies like Reitmans that are smaller that probably no one looks at. And this is another reason, just the confidence. You can again the same theme, right? Good times to buy. So you can see here we're down here again, which is again around the COVID panic levels, around the Powell pivot levels, and then you have the great financial crisis, which we're almost approaching. So pretty bearish out there. So it's getting me more and more excited. This is just another way to look at it again. These are all in Yardini. He's someone that I start following more when I need to buy more. If that makes sense, he's normally a long-term bull, so I like to follow people that are long-term bulls and times when I need to start. I know I should put cash to work, right? And then here's this another consumer sentiment on the Fed. And it's back down to, it's actually really bad. Back down to great financial crisis levels. So the consumer does not like inflation. All right. Reitmans is an interesting one. It trades on the venture. So that's your first kind of iffy flag. And the history of it in the last decade hasn't been great with the emergence of Amazon, right? And that's true with most retailers, especially if they didn't have a speciality. If you weren't super low cost, or if you weren't super high end, Walmart and Amazon kind of really took it to you, right? Anyway, you can see great financial crisis. It actually went down to $8, then it bounced back. It actually had decent results in this period up here in 2011, and then it's been a pretty steady downtrend, like hard downtrend, right? And then it bounced again, this time around $3, and then we go to more recent and pretty much the decline into bankruptcy. Still traded on the venture then, and then it's started to shoot up. And I looked at it here because I saw the move, right? I was like, well, I'm not going to chase it. But then I started looking at the company and starting to come back down with the general markets again. And I kept getting more and more information. Like the last annual results just came out, and they're pretty good. We'll go through the numbers right now. There's going to be more numbers on this one because it's more of I'm more of a numbers guy. Obviously, it's not like I'm a big Reitmans fan, but I'm just trying to see where the opportunity is, right, at this specific time. So we'll do 4 years, but I'm going to look at 2 years first just to show you the year-over-year comp. Like most retailers, last year was too good to be true, and we're going to mean revert. And the trick is I don't know how low we're going to mean revert, so I need to make sure that the price that I'm paying is pretty good. Revenue is coming back mainly because they just had more stores open than this was an easy comp year for them because when stores are closed, Reitmans generally does less sales. The online business actually started picking up, which is interesting as well because the online business to me didn't look that great when I went to their website. But it is we're talking a market cap of $50 million, right? So it's probably doesn't have the resources to really spend on online, but they have an online presence and they have a brand presence, so which is something that a lot of other smaller retailers that would be priced at this level would not have. Anyway, so revenue's up because it's recovering. The main thing here is COGS only went up 7.5%, but revenue went up 24.1%. There is some noise in here, but it also shows that the margins did improve quite dramatically. Now there's the COVID effect here. Like with most retailers, you didn't have to do as much promos because anything you had on the shelves was selling pretty good last year because all the demand shifted from, say, a balance of services and goods before COVID to basically just goods and services were close. So anything that was a good did pretty well last year. And we're starting to mean revert that, right? We saw that in Amazon's numbers as well. Which is an interesting call. It's actually pretty short if you guys listen to it. Anyway, they had this big gain, or we'll talk about SGA. So SGA is also actually went down on 24.1% more revenue, which is really crazy. So when you're selling 24% more, you'd expect some increase in SGA, right? Marketing expenses, stuff like that, but it actually went down. Now, there's a lot of noise here. This is what makes it hard, this line. So this is a line I'm going to look at the next quarter, and the next quarter, and the next quarter. This one to me, like I know margins are probably going to mean revert a bit, but this one is the real one. Like how much leverage do they actually, how much expenses did they actually cut out of the business that's actually permanent, right? Because I don't know. And I couldn't figure it out when I went through it. There's just too much noise to be sure. So anyway, creditors. So this is the fun. We'll go through the monitor report and the bankruptcy filing. But this one is interesting. So basically they had a big gain booked this year. So it won't repeat. So when you look at the net income, just don't look at that swing because that's a little bit misleading because of this huge gain. But basically the creditors decided that they were only going to walk away with, or they negotiated with Reitmans that they're only going to walk away with 50% of what Reitmans owed them during bankruptcy. Roughly 50%. It was about $200 million. And they paid something, I'll just call it half that. Anyway, they had a gain of $88 million, which is more than the entire equity market cap of the company. And that's why the equity shot up as much as it did, because it was trying to reflect that all of a sudden the company's worth $88 million more to the equity holders because the bondholders decided to take a haircut. Now that sounds good, but again, when creditors take a haircut, usually means they're not going to lend to you right away, right? But BMO gave them a pretty large line of credit, $115 million or so, I think. We'll go through that as well, as long as I don't edit it out. But I know this one's going to be longer, so we got a lot to go through. So I'm going to talk fairly quick, but all right. Anyway, so they got a big gain there. So operating income obviously shoots up, but we know 88 million of this 143 million is noise, right? We also know there's this SGA line is probably too good to be true, so there's noise there, right? So I'm trying to see, okay, what's the actual EBITDA here, right? It's hard for me to tell. And there's depreciation up here too in the SGA line. They closed some stores. We'll talk about the discontinued operation. They closed 2 banners. We'll go back to here for a second just to show the banners. So one of the things that happened over time during bankruptcy, they closed their 2 underperforming banners, mainly their plus size one. Additional was the one that I was most familiar with. They closed that brand. That's never coming back. And they also closed this one, Fine Maternity. They've closed those brands permanently. You can see here that they used to have 77 stores of Additional and 54 stores of Fine Maternity. Well, actually, I had more than that before COVID. But anyway, these brands are not coming back. And you can see the store count go from 600 to 400, which I like, right? So they cut their leasing expenses, assuming they were all linear and all the same. say they have 50% less lease expenses, but their sales aren't that bad, right? They're actually rebounding well. So it tells me that they cut a lot of fat during the pandemic, during bankruptcy, which is you're pretty much forced to, right? You gotta have a plan for the creditor to be like, all right, we're gonna turn this thing around, right? We're gonna emerge from bankruptcy stronger. And so far, based on the results, it looks like that, but it's really hard for me to tell. And a part of that is because I'm not used to looking at companies that are coming out of bankruptcy, right? And net interest expense low. The debt now is pretty low for the company. We'll go down here on the balance sheet this right now, but you can basically see on the balance sheet side, cash went down, so they paid off the debt. Inventory is starting to creep up, but it's not back to its main level yet. So that's what got them in trouble last time. So I'm gonna watch inventory and SGA the most on the next quarters to see what's going on. Can they manage their inventory better? Because a lot of the creditors that took a haircut were actually at trades payable, which was basically accounts payable for inventory. Intangible assets took a haircut, but again, it's pretty small relative to the company. Well, I mean, with a market cap, now this market cap's super low because it was pricing in basically a certain bankruptcy rate. Your equity holders are not going to get anything. So it priced in a market cap of 7.8 million, and now it's at worth 61 million, right? Just for context, when I unhide these columns, it'll be a little bit messy here. We'll go through all four in a second, but maybe I'll keep it like this. It helps you see the trend. Hopefully you guys can see that. But I'll go to market cap first. So here you can see the share price under pressure going into COVID. It's not like it was in a good place, right? Some pretty big losses. Revenue was going down, but the SGI line was barely going down. Margins were coming down because they were discounting to move inventory, right? So it wasn't a great spot going into COVID, and that got taken out right away. They decided to just declare bankruptcy. Anyway, the share price sniffed it out, and you could see that the market cap went from 230 million in equity to 45 million in equity to $6.1.5 million in equity. They even said something funny on their asset side here that they decided to sell some marketable securities and then buy back their shares with them. So the share count actually does check out. They actually did buy it. They were trying to support the share price as it was declining as much as it was, as fast as it was, right? But at the same time, they needed the cash, right? So what else is there? Basically what happened is this total indebtedness line here. They had quite a bit of, well, here you can see the jump in assets and the jump in total indebtedness. Really, that's them putting or total liabilities and total assets, rather. You can see a jump, and that's them putting their lease liabilities on the balance sheet. So IFRS 17, no, sorry, I think it's 16 is the lease liability one. Basically, the thinking was, hey, we want you guys to show how your exposure to your leases on your balance sheet, right? So what they did, normally you would just say the straight line is lease expense over the life of the lease and just expense it, right, evenly over the period. And the cash flow, you just would mark it down as cash as you actually paid the landlord. But then when they switched IFRS 16, the thinking was, let's put all the liabilities on the balance sheet so investors can see it, right? And so what they had to do to on the other side of the balance sheet is mark up right of use assets. Basically, it's this generic thing. And instead of straight lining it, they would depreciate the right of use assets over the lease life. So it's a little bit different. And so you're going to see depreciation expenses increase, but you're going to see lease expenses decrease. Cash flow wise, it didn't matter. And we all know that when you pay rent at the first of the month kind of thing, that's when the cash leaves, right? To whoever the REIT was, that was their landlord, because they only own 2 properties, which we'll talk about. They actually leased those 400 stores or whatever, those are all leased. So anyway, they had quite a lot of leases, but they've been able to shoot them down. That's what's getting me excited here. Is, okay, not only did they restructure the company, got rid of the 2 underperforming brands that we'll talk about, they also renegotiated the leases. And they cut, obviously, the banners. The employees with those banners were also reduced to make it through bankruptcy. Right? Bankruptcy is never a pleasant process. This year, ultimately, retained earnings shot back up because the net earnings was good. Part of that's this gain. But so the balance sheet actually looks really clean, right? We have 25 million in cash, quite a bit in inventory, but we only have 29 million on revolver, right? So if I take this 25 million in cash that they had and then apply it against this revolver, their net debt was only 4 million. So when I look at their EV, it's only around $65 million, right? at 100 or $1.26 a share. So anyway, and you got to remember the company just put up operating income of 143 million. I mean, we take out the gain of 88 million. I'm thinking somewhere EBITDA might be in this $50 to $75 million range, but I can't tell that. So technically, it's trading under 1 times EBITDA, which means the company could buy back its whole company in 1 year. Technically, but they haven't done anything yet. They haven't even given guidance. They haven't given anything. I think part of that's because, in my mind, I think the creditors walked away not demanding enough from Reitmans. And I think that's what the equity price was trying to show during that late part of 2021 in December. Basically, it was the market's way of saying, whoa, the creditors walked away with giving them $88 million they didn't have to pay. Right? They were never going to get full recovery, but it was quite low given the underlying operations appeared to be quite healthy. No, they weren't going into COVID and during COVID, but coming out of COVID, and especially last year, they're actually doing pretty well the last few quarters. And you can see that in the monitor report, because every quarter they would have this report out that Ernst & Young would do, who is the appointee for the bankruptcy court for them. You can see the business getting better and better every quarter. So I'm surprised at the end of the day the creditors demand more at the end. But anyway, equities reflected that. But now it's pulled back with the general market. Got technically cut in half. Here you can see that they actually were paying dividends, even though their share price was collapsing. They slashed it here while the business was really showing that they were struggling. And then they decided to use some marketable securities on their balance sheet. I don't know who they're invested in, but they sold it and bought the company back. All right, let's move a little quicker here. We'll just look at the margins over time. So this company wasn't that great as the baseline years are horrible, right? And the current year is probably too good to be true. So it's hard for me to judge what's actually true, right? Or what's sustainable in the long run. The company has given no guidance. They don't even have an investor deck. Right? They probably don't even have an IR department. I've messaged some contact us things to try to say, hey, did you guys think about this? Right? To increase value to shareholders, but I haven't got a reply or anything. So, right? Because when I look at this, I'm like, I think I'm missing something, right? When it's this cheap, because technically it's trading under 1 times EBITDA, right? It's technically trading at almost 6 months EBITDA, which is crazy, right? So maybe I'm missing something here. I'm going to keep going back to this one, I think, because this is a fun one for me, because it's a different element, bankruptcy element, right? So anyway, they have emerged from bankruptcy stronger based on the metrics, but I don't know how strong. That's what I'm trying to say. So margins, technically speaking, they're not that high. They're back above 50, which is good. You got to remember these years they were discounting inventory pretty hard to try to move it, right? And then there's also noise from impairments and write-downs and all that stuff here. So this is probably too bad to be true. And this one's probably too good to be true. And this is the baseline here that I'm trying to figure out, right? So traditionally speaking, in terms of EBITDA, the company is actually decent. I mean, they were paying a dividend at some point, right? Which isn't small for a company that's now only worth $65 million. They paid $20 million in dividends in the last 2 years going into bankruptcy. So this is a fun one. So I was like, okay, you guys this is what they put on their annual. They did $95 million in EBITDA, right? Which is pretty crazy. So technically trading at 9 months EBITDA, according to their EBITDA. But I'm not convinced that that's the one that I should use going forward, right? And it's not like there's any guidance or management telling me what's going to happen. So anyway, I halved it and said, okay, this is what I want. I think the company could probably put up 47 million, which is below what they're doing before. And it gives me a margin of safety. And then I'm okay. So now it's traded at what? 1.25 times. Yeah, 1.4 times EBITDA, which is still dirt cheap, right? Technically, that should be trading over 3 easily, right? Maybe even 6, 8 if it was a good company. Maybe even 10. But anyway. If the company can prove that it did come out of bankruptcy stronger, then I think the share price is going to slowly move up over time. And if it doesn't, management should be buying back the shares if this EBITDA is actually true, because that EBITDA should be telling of what cash flow is. Now, not necessarily because if inventory gets out of control again, then inventory or the cash flow will go to the inventory, and the inventory will sit there, then they'll discount it, and then it'll be the whole cycle over again, right? So they did make some permanent changes, right? Bankruptcy forces you to restructure, right? So they did close the 2 stores. Usually it always closed the underperforming brands. We'll go through the discontinued operations in a second, which reflect the 2 brands. And again, these are all notes to myself. I'm going pretty quick, so you can always just pause and read them. But, there's a couple things here, like why did the Reitmans family own more shares of the company? I'm surprised they haven't taken it private given the currently low valuation. Right now, there's some rent negotiation here that I think is sticky. I'll talk about that as well at the end of the video. It's gonna be a longer video, and there's so much to go through. So sorry guys, it's gonna be longer. On the monitor report, Ernst & Young is a noted monitor. Anyway, the monitor reports are very good for tracking how the company is doing, because basically the monitor is monitoring the company during bankruptcy to making sure that they're doing everything they can to protect the credit. Like when you're already bankrupt, sometimes we'll just be like, well, it's already bankrupt, why I care, right? The creditors care. So they still got to run the business like a business even during bankruptcy, right? Even while you're restructured, you can't be willy-nilly. So this guy looks at it, Ernst & Young, and they're basically saying, and if you read them over time, you can see how the business improved from the clause of COVID all the way up to the current last 2 quarters, which are really, really strong for the company. So anyway, on I think number 9, I'm pretty sure it's number 9, on page 22 of that one, there at the end, appendix C, they have a liquidation value. So basically the monitor appoints these appraisers to appraise certain assets that Reitmans owns and tries to say, hey, what's this actually worth? My notes here might help. So this is just taking an example of that, highlighting certain things. So inventory, the appraiser will always fire sale inventory. So we always see the low range here. Basically, when you're in bankruptcy liquidation, you're going to get the liquidation value. So it's going to be less than the carrying value of the inventory, which is always usually true. But the fun one here is the property and equipment. And I did like intangibles because it's funny to see what they think the brands of Reitman is worth. But anyway, the main hidden asset here is the land value. At least to me, because it's only worth $65 million on the books, but they appraised it for at least about $114 million, which is, again, that gain right there is almost as big as the current equity market cap. So that's a double if they sold it and bought back the company. Right, dudes do sales leaseback like City Trends is doing, right? This company hasn't said anything. Anyway, you can see here what the 2 properties are. Basically, this VRE Limited says that's what those assets are worth. There's more than that in there. There's like furniture and stuff like that, but you get the idea. Basically, there's hidden assets on the books. That's usually the case because buildings and land's booked at historical cost, and then buildings are booked at cost and then slowly depreciated over time, even though the actual value might be increasing over time, right? So one of the things I like to look at is the company changing. And again, this is the 600 stores, 582, bankruptcy 415, 404. So they're still cutting stores, which I like. Basically, cut the fat, lower the lease expenses, which got you into trouble, and hopefully they can manage the inventory, right? That's the idea. So the 2 red flags for me is SGA going to start scaling up crazy, and is inventory going to start scaling up crazy, taking the cash flow that the company should be doing to support the share price, and because you could buy a meaningful amount of the company for very cheap here. Now, there could be some barriers to that because the creditor might have some covenants that says, no, you got to make sure you have no debt and pay me my revolver that I gave you down fully first before you can do anything with the cash, right? There could be a whole bunch of stuff that BMO negotiated with Reitmans, because Reitmans technically just, you always want to protect yourself as a lender, especially when a company does cut their creditors in half. So, and I'm not familiar with the terms of the credit facility, though I did try to find it. I couldn't find the covenants. Earnings loss from discontinued operations. So we talked about the 2 banners being gone. And in my experience with the company they'll try to lump a lot of expenses as restructuring costs against it. So the prior year they put a lot of cost against this discontinued operations. So I'll have to see if that's true, because if it's true, this is very strong for the company. Could explain why the company is looking superior if this company was actually operating at a $71 million loss, those 2 banners. But I doubt it. You can see that the actual business wasn't that good for these guys, so you can see why they cut it, because this is harder up here to add things to after the fact. So you can see that their gross margin dollars was only $2 million they're walking away with. 22 minus 20, so operating margin $2 million on $74 million of revenue. So yeah, it makes sense to cut all those stores, because those are quite a lot of stores, right? So this one's just to flag what the settlement was, because this is a reason for the large gain and a reason why the equity price shot up, and a reason why I'm interested, obviously, because it's out of bankruptcy. So you can see here on January 12th, 2022, the company paid the monitor the $95 million agreed amount. Concurrently, they secured a senior secured asset-based revolving facility. So, okay, secured asset-based. So that might explain the land, right? The land might be secured because they only have those two big assets. So in order to get their facility and a fairly low interest rate, they probably secured the base to over to get whack. And the creditor probably wanted that as well because of what just happened to the company. The new creditor, BMO. So revolver 150 million or US equivalent. Does mature 2025, so 3 years. Again, this is discontinued operation stuff. You can see that 1,600 employees were let go. And again, they comment about the inventory here, which is what I'm focused on, right? They're saying it's higher because we're selling more because more stores were open. Well, more stores are open and then we were selling more. But anyway, you get the idea of what I'm looking for over time, and this kind of explains some of the credit facility. But again, there's no, I mean, I know there's covenants, I just don't know what they are. At least we know that it's secured probably to those land values, which helps explain why the interest rate is actually pretty low. So SGA is interesting. So this is the quarterly one, so the most recent quarter, and we did see a tick up in SGA. Right? So that's why I know SGA is higher than what it currently is showing. Or at least that's what I think. So that's why I'm making this instead of that 90-something million that they say their EBITDA was for 2021. I'm pretty much having it. It's like, nah, just to give me a margin of safety on my investment, right? Because I do own this one. Here you go. 7,000 shares at 135, basically. We'll have to see what happens with this one. But I am in this one because every time I go back to it, I'm like, oh man, it looks too good to be true, which is always scary. Your expenses are up because you had less government support prior to last year. Increased their wages for the store personnel because there's more inflation. They have started to increase spending on advertising again. Partially offset by improved lease arrangements with lease negotiations in a fewer number of stores. Again, you have a decrease in depreciation, which is helping because of the reducing the number of stores. And then all of a sudden they paid themselves $2.1 million of discretionary compensation bonus to head office employees. So basically, hey, you get some money because we made up your bankruptcy. They've also just issued warrants for their bigger directors to strike price at 150. So they're trying to reward their leadership for making it through it, which is interesting. So I'll watch this as this continues, and I'm like, okay. Because again, $2 million when your company's only worth $65 million is interesting, right? Because you get a multiple on that. Anyway, I just thought it was interesting to show that. And then on the balance sheet here, now this is the Q3 quarter. I was digging a bit on page 16. The right of use assets decreased by $64 million, probably due to depreciation, amortization, lease modifications, most of the renegotiation of leases. It says right here, i.e. fixed to variable lease. Now, I don't know how many of their leases are fixed to variable, but I like fixed to variable leases for this company. Right? So instead of paying a fixed amount every month, you're paying variable based on sales, or maybe a combination of both. A lower fixed amount, but a higher variable, right? So if the company does well, they spend more in lease expenses. The company does worse, spend less in lease expenses. Right. Now, I don't know how much of the leases, like I said, are, but that's what I wanted to see. Because that was the two risks are inventory, and the second risk is lease expenses. Still stacking high as traffic comes back down, because we know malls over time have a hard time against the Amazons of the world, right? Anyway, Primaris is a company that reported they're a landlord, and that says the opposite end. So Reitmans is a tenant, or not necessarily a tenant of Primaris. Primaris is by example, but Primaris is a landlord and Reitmans is a tenant. And so I'm trying to say, okay, well, how's this relationship going, right? And I thought this was an interesting opening statement from Primaris, who's basically enclosed malls. And they have some other malls, but mainly enclosed malls. Now, Primaris also trades at a material discount to their actual asset value, which is interesting. So this company might be one to look at too after. I don't know, I think it's trading at like $13, but it has a NAV in the 20s. So anyway, no one really wants to touch enclosed malls or retail, and I think that's telling of the valuations. But I thought this was an interesting comment. The food courts, typically a barometer of mall traffic, continue to show rising sales activity. February and March sales being at 80% compared to pre-pandemic figures. And then Q4, they were only at 75%. So basically, they continue to see a recovery. And here you have first sales average 91% compared to the pre-COVID comp. So businesses and traffic is still returning during Q1. Right? Now, January is bad. It's probably why it's not on here because of Omicron. And we saw that with a lot of numbers on the travel side, but now we're seeing it on the enclosed mall foot traffic side for food courts, which I thought was interesting. Just a little add to here, because it might tell me how this Q1 is going to work. Like, I know January is going to be weak, but maybe February and March are okay for humans. And then after that, assuming no more variants, no more shutdowns, then maybe the company can continue its trend forward. I thought this was interesting. So the anchors, I think I've gone through a couple of REITs before on the channel, but basically anchors are your big guys. We'll call them Walmart. We'll call them Loblaws Superstore. Basically, your big guys, and they did quite well during COVID when everything else, the mom and pops were shut down. A lot of traffic went to these big guys. When restaurants shut down, we saw the big, huge volume increase in grocery stores and sales and foot traffic. So what they've done here, you can see the percent spread. They've actually increased the rent on the big guys who've done well lately. Now this could also be variable, but I don't know. And they've reduced it on the CRU, so the commercial retail unit. They've reduced it on them, which would be able to fall in for Reitmans. Now this isn't. They don't show Reitmans here, even if they were a tenant, right? They're only going to show their top 20. I think they only have to show their top 20. There you go. There's a top 20. They don't have Reitmans on it. So I don't even know if there's a relationship here with Reitmans, but it's trying to tell me what's happening in the industry between the tenant and the landlord. One of the things with occupancy is the landlord always has to try to maximize occupancy without decreasing rents, right? And ideally increase it with inflation, and then maximize occupancy to get the most value out of land. So occupancy has been kind of, lately it's improved since obviously the COVID pandemic initial response, but it's still not great. It's not like amazing. So I think what's happening is that the landlords are trying to find decent tenants to fill the occupancy gaps, and what they're doing is increasing the rent on the big guys and decreasing the rent on the little guys. So basically trying to make it, now it could be decreasing rent on the little guys because they're switching to variable leases instead of fixed leases, right? Which is probably why Primaris was mentioning the sales were back to 91%. It's 2019, right? So there's some of that going on too. But it kind of tells me that the landlord's obviously aware that they need to maximize the occupancy, so they're lowering the rent on the little guys and increasing on the big guys because the big guys have done so well and the little guys have been struggling. Right? Makes sense. Anyway, I thought I'd just include that part at the end. Again, this is just the adjusted EBITDA from continuing operations at 94.8 million. That's what they said. I mean, if you believe that, you should buy it. But even if I have it, it still looks too good to be true, right? When a company's trading at, well, we know, 29 million in debt, but you have 25 million cash, 4 million net debt, and a $61 million valuation. You're at $65 million bucks, so you're trading at less than 1 times there, just the EBITDA. But maybe if I have it, you're still at like 1.4, 1.7. So it's an interesting time anyway for this company. You can see why I'm in it. You can also see the caveats that I'm not that familiar with bankruptcy court, so all I know is I'm going to get rug pulled on me. It's an interesting one, that's for sure. And it's emerged from bankruptcy stronger than it went in, at least as far as the last year's financials are concerned. But again, there's a lot of noise here. You have a non-repeat gain, you have some lease negotiation gains, then you had the lack of promotions because anything you had on the shelves were selling. I'm expecting this line to come back up a bit, this line to come back down a bit, this line not to exist, this line not to exist, right? And then you get a more realistic EBITDA, which I'm thinking is somewhere between that, well, my low range of 47 and their high range of 94, right? I'm thinking it's somewhere between 50 and 75, but it's like I'm guessing, right? And there's no guidance, there's no anything, so I have no idea where to look for some certainty. But it looks good on this year anyway, that's what I'm trying to say. Hope you like this Reitmans one. Again, it's a little bit long. I'll try to edit some of it, but have a great rest of your weekend.